Meet Alex and Ben. They both started trading on the exact same day with the exact same account size, $10,000. They even traded the exact same stocks, but 6 months later, Alex's account is completely wiped out. Zero. Ben? His account is up 30% and he sleeps like a baby every night. What did Ben know that Alex didn't? It wasn't a secret algorithm and it wasn't insider info. It was one simple, boring concept that separates the gamblers from the professionals: risk management. Most new traders approach the market like a casino. They find a stock they like, get a rush of adrenaline, and go all in. They think, if this goes up 20%, I'm making $2,000 today. But they never ask the flip side question: what if this drops 20%? The market doesn't care about your feelings. It's a machine designed to transfer money from the impatient to the patient. When you risk 50% of your portfolio on a single trade, you aren't trading anymore. You're hoping. And hope is a terrible financial strategy. It takes just one bad headline, one missed earnings report, or one market flash crash to wipe you out completely. So, how do we fix this? Enter the golden rule of professional trading, the 1% rule. Here's how it works. No matter how confident you are, no matter how perfect the chart looks, you never risk more than 1% of your total account capital on a single trade. If you have a $10,000 account, your maximum loss on any given trade is exactly $100. Think about the math. If you lose 5 trades in a row using the 1% rule, your account is only down 5%. You are still perfectly positioned to catch the next big wave. But if you are risking 20% per trade, 5 losses mean you are completely wiped out. Game over. The 1% rule keeps you in the game long enough to actually let your winning strategy work. Now, how do you actually enforce this? You do it through position sizing and hard stop losses. Before you ever click buy, you need to know exactly where you will admit you were wrong and exit the trade. That is your stop loss. If you buy a stock at $50 and your technical analysis says the trade is broken if it drops below $45, that $5 difference is your risk per share. If your total allowed risk is $100, you simply divide 100 by 5. That means you can safely buy 20 shares. If the stock hits your stop, the system automatically sells. You lose your $100, you take a deep breath, and you move on to the next setup with your emotions completely intact. Trading isn't about making $1 million on one lucky guess. It's about survival. It's about protecting your capital relentlessly so that when the perfect setup finally arrives, you actually have the money to take advantage of it. Be like Ben. Respect the risk, and the profits will take care of themselves. If this video changed how you look at the market, hit the like button and subscribe for more strategies on building real wealth. See you in the next one.